ASML reported strong second quarter numbers today, with net sales of 9.3 billion euros and gross margins at 54%. Yet the stock did not rally. When a company prints a blowout quarter and the market shrugs, it suggests the growth is already fully priced in at multiples above 40 times earnings. We are seeing a distinct capital rotation out of high-flying semiconductor names and into other quality growth sectors. To support its long-term outlook, ASML is planning a major capacity expansion. The company intends to add 30% to its low-NA EUV equipment manufacturing capacity in 2026 for the 2027 shipping cycle. It is also investigating another 30% capacity increase for 2028. This expansion reflects robust multi-year demand visibility for advanced lithography machinery.
Alphabet received a notable vote of confidence as Warren Buffett personally initiated Berkshire Hathaway's $10 billion purchase of the stock. While Buffett has stated he considers not buying the company earlier a mistake, this direct capital allocation dispels retail rumors that the investment was solely driven by Berkshire's co-portfolio managers.
In the financial technology space, Stripe and the private equity firm Advent are rumored to have submitted a joint $53 billion acquisition bid for PayPal at $60.50 per share. While all parties have declined to comment, the rumor establishes a firm valuation floor for legacy payment processors. Fintech investors are modeling that a contested bidding war could push PayPal's valuation up to $70 or even $100 per share, which would represent 15 times free cash flow. This math is supported by PayPal management's guidance of $6 billion or more in annual free cash flow, highlighting durable cash generation. Looking at the broader macroeconomic picture, the Federal Reserve's newly released Beige book reports a structural shift in the domestic economy. Growth is transitioning away from consumer spending and toward capital expenditure, specifically driven by massive investments in artificial intelligence data centers. In terms of interest rates, New York Fed President John Williams suggested today that inflation may have peaked and the current policy rate is appropriate. This dovish commentary supports the argument that the Fed can maintain current rates without needing further hikes to stabilize prices. However, other central bank signals remain hawkish. In testimony before the House Financial Services Committee, Federal Reserve officials indicated they will no longer look through supply shocks to excuse missing price stability targets. The Fed's balance sheet focus is pivoting strictly towards inflation containment rather than financial market backstops. To manage the rising supply of Treasury debt, the Fed is outlining regulatory adjustments. The plan involves deregulating large commercial banks so they can absorb Treasury issuance, while simultaneously easing regulations on smaller banks to encourage credit expansion in the real economy. Global dollar shortages are prompting aggressive central bank actions. The Reserve Bank of India is subsidizing 100% of the hedging costs for 3 to 5 year foreign currency deposits in an effort to attract $50 billion. This comes as the RBI's short dollar forward book reached a record $106 billion in May. The scale of global dollar tightness is reflected in Federal Reserve custody data. Foreign official institutions mobilized $28.6 billion of Treasury reserve assets from the New York Fed in the week ending July 8th, indicating central banks are actively liquidating holdings to defend depreciating currencies. Geopolitical risks are adding to global energy costs. Renewed tensions involving Iran have pushed crude oil prices back toward $95 per barrel. Higher oil prices expand dollar funding requirements for importing nations, exacerbating the global currency squeeze. In megacap valuations, Google is facing a fundamental reality check. Analysts suggest the current stock price requires a 15% annual growth rate for the next 10 years to justify its multiples. Meanwhile, Nvidia's valuation has become its cheapest since early 2019 on a forward price-to-earnings basis, despite rising concern over hyperscaler cash flow margins.